Hi everyone, welcome to Coffee Chat with the Chen and Val here. Val is an accomplished accountant, and he has a ton of experience within tax accounting as well as audits. And today he's here with us to be able to talk about RRSPs and just breaking down the tax implications with about a lot of this. Val, welcome to the show, and it's nice to have you here.
Thank you, Chen. Thanks for inviting me to this coffee chat.
Well, tell us a little bit about you first, and then we'll kind of get started with that.
I'm a chartered professional accountant, and under my firm Val Purushothaman CPA Forensic Professional Corporation, we do financial audits, reviews, taxation, tax planning, plus forensic accounting such as valuation, litigation support, etc. So I have been doing this for about last 35 years, practicing accounting and taxation.
How do you like it?
Very interesting. And we have seasonal changes and having to cope with increasing legislations. It's interesting.
Right on. Awesome. So in the interest of time, we'll dive right into sort of like RRSPs and just having a quick casual chat about it, right? It's that time of the year when everybody talks about RRSPs. We, at least within the financial planning side of it, or when clients just think about it, they think about, hey, tax deductions, let me go put in some RRSPs just to get that. But what I wanted to do with you today is just kind of go down a little bit deeper into that and just have an honest conversation as to why RRSPs, how does it actually form part of sort of an overall financial plan, and then sort of talk about it from that angle, right? Val, why don't you break it down? Like, what is RRSPs? Why do we sort of talk about it quite often, in Canada?
I would start with a very interesting description of RRSP as it is a Canadian culture. And if you have to take out RRSP, the culture wouldn't accept that change. So it's so embedded and Canadians have accepted. Basically, it is a tax incentive for anybody to save towards your retirement. When you retire, you don't have work and you have less income. So that's the time your savings kick in. So they give you tax incentive for you to save.
Right on. And when you say tax incentive, the first thing that sort of comes to my mind is when somebody contributes into an RRSP today, ideally it's an incentive for you to be able to save towards retirement, but you actually get a much more immediate incentive today, and that's sort of the deduction that we're talking about. Can you elaborate on that a little bit more?
Let's say you're on a top bracket of your taxable bracket, and then you decide to put aside 10,000 of RRSP, and you are at a high bracket, and you're making very high level of income. So what happens is, the minute you decide to put aside 10,000, your taxable income comes down 10,000. So when the taxable income comes down 10,000, your taxes payable will come down by, let's say, 50 to 55%. So you got $5,500 to fund your RRSP purchase as well. So you may want to get your RRSP 10,000, but the tax money is helping you to put aside that money. That's a tax incentive. In other words, the government is giving you 5,500, your out of pocket is 4,500. So that makes up that 10,000. That's the first incentive.
Right on. And it's perfect because usually you can take that money and then you can invest it towards anything else you need, or you can use that money for anything you want at the end of the day, right? Because everybody is keen on making sure there's a refund that sort of comes your way, and RRSP sort of accelerates that part of it. So that's the first incentive where you get sort of an immediate tax bracket or tax break per se. I know there's a second incentive to it that's essentially anything within the RRSP essentially drives toward a tax-deferred growth at the end of the day, right? So what's your take on that, or how do you sort of explain that to our viewers?
I think the second part of that is amazing as well. Initially, you're given an incentive to put aside some money, and later on, once you put aside some money and nobody comes and taxes on that for any growth that's experiencing. So that goes within the RRSP, that grows without any taxpayers, CRAs interference with tax levy on that. So once it matures, it comes a lump sum. When you take it out, then that's the time you will pay taxes.
Amazing. So if we were to sort of break that down a little bit, the beauty of that is if the funds were sort of invested in a non-registered funds, for example, there will be taxes on it on a yearly basis, which means it sort of deters the growth at the same pace per se, versus in a registered investments like an RRSP, which obviously there's a tax incentive. As funds are growing, it's completely tax deferred. So on the growth, there's no taxes on it until you sort of withdraw at the end of the day, which sort of automatically leads us to that third part of that conversation, which is at one point or the other, there are going to be taxable implications, when you're withdrawing the funds. And that's sort of when you sort of take the money out of the RRSP. What is sort of, if you were to look at sort of the ideology behind RRSP, what is that ultimate, are you typically in a much lower marginal tax bracket in your later years when your sort of retirement income is a little bit lower than, when you're in your peak income earning years? What's your take on that, and why do sort of people want to take the money out during those time of the years?
It's a beautiful question. If you look at your income, your income when you get into employment, it's at a pretty low level income. So I break that RRSP contribution into three phases. One is you are increasing or accumulate your contribution room. So when you're in a lower income, let's say, for example, you're below $50,000 income, taxable income, I recommend them don't even bother contributing. Because if you contribute to your RRSP and RRSP, you're going to get about low tax brackets. But some people say, as a discipline, they really want to do it. And if you do it and you get tax incentive, it's not very, inducive compared to the ones you would be contributing at the level of $200,000 income. So you will accumulate your RRSP room. Then you will rise up to your decent income, let's say 100 plus or around that area, or 80 plus. At the time you start using all those contributions and bring your taxable income down, and your income will go down. It's like a graph. It goes to the peak and peaks out, and then it might come down a little bit, and then you are into retirement, so it's going to be a drastic drop. So what happens is at this very high interest you are earning, or your income levels, you would tend to pay very high. Your marginal rates are high. You're paying at a higher rate. So when you put aside some monies, and the reward for putting aside RRSP is high, so you would have substantial saving it. So you can leave them in those RRSP to the maximum. You can only contribute to your maximum, of course, and leave aside. And if you have excess, you can put aside those savings to work for you. And when you reach your retirement, of course, you are not going to work, so your employment income is going to stop. People don't realize that it's huge drop in you're working on a $200,000 income, all of a sudden you don't have that income.
Yeah, and it's because, from a lifestyle perspective, we are used to a lifestyle where we used to be able to earn that $200,000 or $100,000, whatever the case may be. And when that's no longer there, that's when we will essentially be able to sort of use these funds to be able to help, supplement that income at the end of the day, right? But it's a beautiful point that you brought up, because I know I sort of come across these scenarios every once in a while. At the end of the day, is RRSP always the right solutions? It may not be the right solutions for someone, and I think one of the points that you made out was absolutely true, which is, if you're in that sort of moderate tax bracket with like maybe a $50,000 tax bracket, contributing to an RRSP may not necessarily give you that large of an incentive for contributing, just because the refund that you might get, for example, will be substantially lower than somebody who's contributing that maybe at a $100,000 tax bracket or $200,000 tax bracket, right? So that being said, I'm sure at those times we would be able to maybe look at other investment options like TFSAs or FHSA for a new home savings account. So depending on those scenarios, we'll definitely look at that. But ultimately, the purpose of RRSP at the end of the day is, hey, you're contributing it, so your immediate contribution is obviously deducted, so giving you an immediate tax break. The second part of it is essentially the funds are growing on a tax-deferred basis, obviously making sure the growth is not taxed, as it grows. And third part of it, ideally, is that when you're retrieving the funds or when you're withdrawing the funds during your retirement, you're in a substantially lower tax bracket, at which point you got the best of deduction when you were in a higher tax bracket, and when you're withdrawing it and you're in a significantly lower tax bracket, literally giving you the tax benefit of maybe paying a lower taxes rather than higher taxes for those same funds that you contributed. Would you say that would be a fair statement at the end of the day?
It is a very fair statement that the concept is exactly the same. So you would save when you have your tax bracket is up, save substantially, and draw your income not all at once, spread that over your retirement period. And there is another mechanism which comes in, which is called RRIF, and retirement income fund. So that after 71 you can't contribute anymore, so you would have to take it out. So you take them in a minimal amount at least, and then you have a mandatory drawings from there, and that spreads over through your retirement savings account. And so that gives you income, and at a lower, when your total income, taxable income is low, so that you pay less taxes.
Perfect. So just because I know you jumped onto RRIF, so let's quickly touch base before we come back. RRIF, it's Registered Retirement Income Fund at the end of the day. I know it's something that at age 70, is it at age 71,
yes.
It becomes that you no longer can convert it into an RRSP, and the RRSP automatically gets converted to a RRIF account while at that point you have to take some type of minimal withdrawals that are coming from the RRIF accounts, just because ultimately at the end of the day, CRA and Government of Canada would like to make sure that withdrawals are happening from these accounts rather than the funds just being accumulated. What exactly is the reason behind it? Do you know? Is there any fundamental ideologies that sort of come with that?
The reason for encouraging the people to take money out of that is if you leave the monies in retirement savings, and you know that retirement kicks in any time after 60, 65 and all. So they allow you to do, let's say 71 years. And it's an also inducement for people, discipline the people, take your money out of there and use it for your retirement. So otherwise, the people will tend to remain in the workforce and taking the jobs away from the next generation, younger generation. I don't know what that's the reason, but it's an incentive for people, and it's a discipline for people to take the money out of there, and they say no longer you can fund your RRSP. There's no RRSP. You cannot contribute anymore.
Amazing. That makes perfect sense. Val, now just to get back to the conversation about RRSP, you hear about spousal RRSPs or income splitting. You hear these different terms just get thrown around every once in a while. What are some of the reasons for that? And can you maybe elaborate a little bit more on what spousal RRSPs are? At what scenarios should we be even considering it from a planning perspective?
This is a beautiful question. Of my clients, I think probably about when the clients come to me, most of them, pretty much about 75% of them are not aware of the spousal RRSP and the benefits of that. It's a beautiful structure where, here the taxation is individual, but there is a family aspect of that too. So it's a combination of taxation in individual taxation plus the family taxation as opposed to the US tax practice. So what happens is, now it is unfortunate sometimes one spouse makes large amount of money and the other spouse is it's unemployed
or
and
stay-at-home
spouse. So just to help assess the situation, the high earning spouse can choose to buy the RRSP out of his own RRSP contribution room, buy the RRSP, take the deduction himself, but put aside the RRSP to the wife, the spouse. So the owner of the plan will become the wife, and the contributor of the plan is the earning spouse. And who takes advantage is also the earning spouse. So everything earning spouse is doing is himself. He has to have the contribution room. He should be contributing the money, and he will be getting the tax benefit deduction. But the wife becomes the owner. So it's very, it's common in your
Yeah.
family life.
Yeah, and that's awesome because you literally want to make sure the highest income earning spouse ultimately gets the immediate tax bracket per se. But there's a real reason why we do the spousal RRSPs. It's when you withdraw the funds, who gets taxed on that? When the spousal RRSP and the spouse who's not sort of earning is the one who now owns the plan, even though the higher income earning spouse contributed funds towards it. If the lower income spouse is the owner of the plan, and when they withdraw on it, who actually gets the tax? Who gets taxed on the withdrawals?
I have two answers for that. If the fund is withdrawn within 2 years, the contributor will be taxed.
Yeah.
It's an attribution rule.
That's right.
If it's withdrawn after 2 years, the spouse gets.
Yeah.
So initially what was happening is the higher earning income spouse will contribute, and lower earning, the stay home spouse will take the money out. So they get a tax, there's no zero tax rate. They get a tax saving. In order to put a stop, they brought an attribution rule. Right. So it said you can't take for 2 years. So you can wait for 2 years and take the RRSP money out, or leave it there until it matures. And then ideally, it's nice to have both spouses to have equal amount of retirement savings fund or RRIF. So when they take out the monies, the pensions, each will have equal income.
Yeah. So just to sort of summarize it, in a perfect world, the higher income earning spouse will contribute the contribution towards an RRSP in the name of the lower income spouse.
Right.
They have to make sure the higher income earning spouse has the contribution room and everything else in order to justify it, and ultimately they will get the deduction or the immediate tax bracket of that. Assuming 2 years have passed and now they're in retirement stage, right, the higher income earning spouse may have other sources of income like pension income and all of that stuff. Right. And the lower income earning spouse may not have many other sources of income. So when they're withdrawing the funds, or when the lower income earning spouse is withdrawing the funds, right, ultimately the withdrawal is now taxed at a much lower tax bracket. And that's sort of the beauty, the best of, you get the best of both worlds, because the higher income earner will get the deduction, and when they're getting taxed on it, the much lower income earner will essentially get taxed on it.
Exactly.
Yeah.
So the gap is exaggerated. He pays at a very high bracket, and he gets high deduction when he contributed, and the lower income pays zero minimal taxes. So the income tax disparity is large, and they take larger benefit.
Absolutely. Now, what's the current RRSP contribution limits, and how does that sort of change as pension adjustments and contributions are happening on a year-to-year basis? How does that change? So let's start off with the contribution limits, and then we'll sort of move on. What are some factors that sort of affects that contribution?
The contribution limit is about 18%. So I believe in 2023, it's about $30,700, the maximum. So now it's being indexed for each year. Now going to 2024, it's increasing to 31,000 and change, 500, I believe. So that's the 18%. And you have to understand this RRSP is calculated only on your earned income. Okay. If you have an investment income, it's not counted. You have a rental property or your interest you earn, that's not calculated. It should be an earned employment income or self-employment income, or such as those ones are eligible. So that's 18% on that. So I had a situation lately, and I had a professional. They didn't take any income. There's all investment income. They had capital gains and all, hundreds of thousands. Their RRSP limit at the contribution room was zero.
Right on. Because they didn't have any earned income at the end of the day.
Yeah, so that is one factor. Then you will also have an opening RRSP. Lots of people are not aware of that. Lots of people don't believe. They believe in day-to-day living. Take the money, spend the money, they don't put aside money. So they have an opening rooms. It accumulates RRSP rooms. So you have an opening room. Each year, earned income will create 18% of RRSP for that year. That adds on to that. And you will also, some taxpayers have an employee's pension plan. So when they plan an employer, there's a pension adjustment. They get pension, so they use this room to contribute to that pension. So the pension adjustment is removed from that. So that's been removed. And then the remainder is your amount that you can contribute. So you have a contribution room large, but you don't need to have to contribute all of them, because what you can deduct, just plan your deduction, what you need to do, and contribute to that.
Got it. So just to summarize it, at the end of the day, you have 18% of your earned income, or up to the maximum ceiling that's set by CRA on a year basis,
Right.
essentially becomes your contribution room that becomes available for you to contribute towards your RRSP.
Right.
That being said, but if you had, for example, a pension at work and the employer contributes towards it, those kind of pension adjustments will sort of reduce that contribution room.
Correct, yes.
And what if, let's say, my contribution room today, where can I find my contribution room?
Yeah, if you in your notice of assessment, you would find there's a worksheet right at the back. The last page will tell you your opening contribution room is so much, and prior year the contribution room that was created by your the assessment, the income for that particular year is so much. So adding to that, and then it'll tell you what is available to you. So you always have to make sure that you don't exceed that contribution limit by 2,000. All you can do is you can contribute 2,000 more than what is allowed, because otherwise you will start getting a penalty for over contribution.
Got it. So always important to know, do not exceed your contribution room, because there are penalties for it. And Val, how does the carry forward part of that work? So let's say my contribution, I picked up my notice of assessment from 2023 or 2022, and I'm looking at it. It says I have $25,000 of contribution room, but I'm only putting aside $10,000 today. What happens to the remaining contribution room? Does that sort of carry forward indefinitely?
It is carried forward indefinitely.
Got it. Awesome, perfect. And Val, how does contributing to RRSP, does that affect any type of eligibility when it comes to CPP, OAS, whether from a contribution perspective or from a withdrawal perspective? Is there any effect of that on any of the government benefits that are available for Canadians?
It is. Yeah, it is a nightmare for some people. They have large amounts of RRSP, and they want to tap into their old age pension when you become 65 years old, and that comes back, and that's been affected by your withdrawal. And at 65, I don't think anybody would start drawing your RRSP. You have time till about 72. You could manage your delay your payments of receiving RRSP in the form of RRIF, but then guaranteed income supplement, that's an additional amount if your income is low. So when you are talking about these high net worth individuals, and usually you will tend to put aside the guaranteed income supplement, because that's not the client you usually deal with, and I rarely deal with. I help them out too, and when the tax planning issues matters come in, they are not really part of that. So those are the people, they need the income, and then the guaranteed income supplement comes in. So it's an additional money that the government put aside, and the threshold is around $21,000, or max. That's the time it starts clawing back on the guaranteed income supplement. So having said that, old age security pension, the clawback starts around $87,000. So it goes unaffected as long as you get net income. It's not taxable income, net income, $87,000, and it doesn't interfere with it. But if you start making more than $87,000, for every dollar you earn, you may have to pay back 15 cents back to CRA. So that's we call a clawback limit. So that's the time it kicks in.
Okay. So just so that I understand, the contributing to RRSP, that's not necessarily going to have any impact on CPP old age security. It's only when the withdrawals of the RRSP happens.
Right.
And if there's a certain income level that's met, so for example, if it's current in 2023, if it's about $87,000, give or take, if there's a net income of $87,000, there might be a clawback of the old age security pension benefits that somebody might have otherwise received.
Correct.
Gotcha. So just in general, so obviously just to be able to recap, from an RRSP perspective, When you're contributing to the RRSP, you're getting an immediate tax benefit at the end of the day.
That's right.
The income is actually a growing tax deferred basis. And then, of course, when you're withdrawing the funds, that's sort of when you get taxed on it. And ideally, you would want to be in a sort of a lower marginal tax bracket just so that you can sort of get a larger benefit at the end of the day. When you're contributing it, you're in a higher tax bracket getting a deduction. When you're paying for it at the withdrawal, hopefully you're in a lower tax bracket, and that's when you sort of accelerate that benefit at the end of the day. But there are a couple of other options where you can take funds out of the RRSP without necessarily sort of paying any type of taxes. And it's there for a couple of reasons at the end of the day, right? And I know the two most commonly used ones are definitely first-time home buyers plan as well as the lifelong learning plan, right? Val, can you maybe explain that a little bit further if you don't mind?
Yeah. So there's one incentive they know that the government introduced to use the RRSPs for the retirement saving, retirement purposes. And they also understand that in order for you to retire comfortably at your latter age, you need to have a house. So they said, okay, here you go. You put aside all your money and you don't have your down payment. So, and this limitations were all set up prior to this escalation of these home prices. Now, I would say if at this age and those amounts will be not $35,000 max, it should be about $200,000 probably. It should be allowed to take. So the people, the first time home buyers are able to take monies without paying taxes for up to about $35,000 for each individual, provided they don't own a house, and they have not owned the house. They are not repaying the home buyers plan, and they have a limitation. So it is not only once. You can do it multiple times as long as you did not have a house, and you can start drawing the money again. Some people have done that. So you are allowed to take about $35,000, and then you will have to put back in 15 years in payments back to them. And how do you do that? Is you buy RRSP and say, hey, this is to pay back those RRSP, and that amount has to go in. So as long as those RRSPs are not contributed within the last 90 days, you can take up to $35,000 for your home purchases, which you are required to pay back in 15 years. If you don't do it, that portion becomes, the amount divided by 15 will become your taxable income for each year.
Got it.
That's one thing.
So first-time home buyers plan, you have a limit of up to $35,000 that you can sort of withdraw. Right. Sure, there's a few qualifying questionnaire that you got to fill out. I believe it's also you or your spouse may not have had owned a home in the last X amount of years for you to be able to withdraw those funds. And the benefit ultimately is when you're taking the money out to put towards your down payment, it's not taxable like if you were to withdraw it for any other purposes at the end of the day, right? So, and then of course you have 15 years for you to be able to pay back that $35,000, so put it back into the RRSP. And if you don't put it back, 1/15 of that, the amount you withdrew becomes a taxable income on a yearly basis until you essentially put that money back.
Right. There are two more points to add, and then let's say you buy a house and withdraw the money, and you have about 2 years. You don't have to contribute this year. You don't have to contribute next year. It kicks in the second year for you to start paying it. So they allow you time. You are just bought a house and you put all your monies in there. You don't have enough income to start paying. So there's a deferred payment for 2 years. It kicks in 2 years later only it will start.
Got it.
That's one thing. And the condition to get that RRSP for the home buyers plan is you, your spouse, or a related person, disabled child should be living in the house.
Got it.
It's not for your investment purposes.
Got it.
People should get that.
Yeah.
Right.
So there's qualification in multiple angles to make sure it's actually being used for that first-time home buyer's purchase.
Exactly.
For you to be able to actually live there at the end of the day.
Yeah.
And there's also another reason, and the Government of Canada has made it so that RRSPs can be withdrawn for if you to be able to go back to school. I know there are some conditions along with that from the lifelong learning plan. Can you elaborate that on a little bit more?
So that's again for you or your spouse or common partner to be able to go on a full-time basis, and the maximum limit per year is $10,000. For the program is maximum is $20,000. Up to $20,000 you will be able to withdraw, and then you had to pay that back in 10 years.